Okay, Cookie, we've got our board out here, which has got all the various categories of those things that influence the Reserve Bank in terms of making its decision. Cookie, take us away, mate.
Yeah.
And we're starting off with GDP.
Yeah, GDP, and this is the checklist that unofficially the RBA look at when they sit down each month to discuss interest
I'm
rates.
calling this Cookie's checklist.
Okay, thank you, Mark. I'll trademark that. But and look, not everything's equal weighting either. Like inflation is much more important than business confidence. But I've got them on there because they are indicators of the economy. So, bottom line issue: GDP growth. How strong is the economy? It's growing over 3.5%. It's in the tightening column.
So they'd like it to be around 3.2, 3.1.
Even a little less than that. They'd want to see it just 2.75 to 3, what we're sort of thinking now for the economy. The fact that we're above 3, they need to keep hiking rates.
Just quickly, though, what's driving GDP up above 3.5? Is it exports minus imports? What are we
It's
looking at?
mainly us consumers. Household spending, is very, very strong.
So 70% of the total GDP number is household consumption.
Is what you and I spend at the supermarket, on holidays, for insurance policies, consumer
So we're
spending.
still spending too much,
We're spending like crazy.
like
Yeah.
drunken sailors. Okay.
Well, the inflation rate we've already discussed, that's the easy one. Well above the target range. That's well and truly in the tightening column. Easy. The labour market, I'm going to put that in the neutral column because we've had 3 months with no net change in employment, 3 months where the unemployment rate hasn't fallen, and critically, absolutely critically, the various measures of job advertisements, job vacancies are turning down. Now, they're not turning down to say, hey, we're going to be having a problem with the unemployment rate, but it's no longer an issue where the RBA would say, gee, we've got to hike interest rates because the labour market's booming. Same with wages, neutral. They have picked up, but they're nowhere near being a problem that we're seeing in the US or the UK where wages growth is way above where it is in Australia. So that one's probably pretty content for the RBA at the moment. The international column, that's one that does go in the easing side.
Because we've got problems.
We've got problems. We've got a high probability that the world economy goes into recession next year. Now, I don't know whether that's, a technical recession or a deep recession, or we avoid recession, but the bottom line, the world economy is slowing. It's slowing abruptly, under the weight of rate hikes, under the cost of living pressures. So I've got that in the easing column, I should say. House prices, I'm moving them to neutral. Okay, they're down 6 or 7% from the peak, but that's after a 26% rise in the prior 18 months. Retail sales, again, another one. That's us spending like crazy. That feeds into GDP. So there's a little bit of double counting here. Consumer sentiment, that is actually in the easing column. So on consumer sentiment alone, which is at a level consistent with previous recessions, just by the way, you'd be saying at the RBA, gosh, that's a problem. We want to be careful about that. Building approvals, neutral. They are falling, but that was after a big bring forward during the COVID stimulus measures, the building measures that were put out by both the Commonwealth and state governments. They've come off. We're still building some more, but it's neither stimulatory or acting as a drag. Business investment, neutral. Businesses are investing quite nicely, but from a very low base. You just want to keep that going. You don't want to hike rates. Businesses, confidence, neutral as well. An important leading indicator. I remember in previous recessions, and I'm sure you do, Mark, that one of the things that predates a recession is when businesses start screaming, we are doing it tough. No one's coming through our door. And we don't have that indicator yet. So I'm putting that in the neutral column. Commodities. I'm going to put that halfway between neutral and easing. You look at the commodity price index, copper, lumber, oil, gas, all these sorts of commodity, copper, they're all turning down, admittedly from a high base, but the broad index of commodity prices is down about 15 or 20%. Hopefully that feeds into lower inflation. So you're at the RBA, you're thinking, oh, gee, it's not too dramatic at the moment. Stocks, the RBA, of course, doesn't target the stock market, but it's weak. So I'll put that in neutral, but it is having a wealth effect. We consumers, one of the reasons why consumers were spending strongly until like right now is because we had a wealth effect. Stocks were strong until the start of this year. House prices were going up at the start of this year, so we felt wealthy with spending. The fact that that's turning down. And last one, the one that really matters, current interest rates, 2.6%. That's in the tightening column. We're only at about neutral right now,
If that.
if that. And the fact that we've got GDP and inflation, the two most important indicators on our little the monetary policy checklist, the fact that they're the strongest elements in this side of the economy. We've only got a 2.6 cash rate at the moment. Says to me that they've got to do some more. So they'll go 25 in my view.
So your view for the November meeting, which is going to be on Melbourne Cup Day, in fact, about 15 minutes before the Melbourne Cup runs, is another 25 basis points increase.
I think at 25, they follow on and just deliver it and sound in their comment, because they put out a nice 600-700 word statement, what is concerning them. They'll identify the inflation problem, of course, but they probably will flag, like they did last month at the last board meeting when they only hiked 25. It was the international side of the economy that's causing Dr. Lowe, the RBA governor, most problems.